What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this afternoon. So what we're going to be covering in this update video is we're going to be taking a look at and analyzing exactly what happened with AMC over this past week. In addition, we're going to be taking a look at the Ortex data, a little bit of a look at the options chain, and then we need to get into and further this derivatives DD that we have been working on over the last couple of weeks and what we are going to see happen with it going in the future. First off, there is a $610 trillion essentially disaster looming. That is the overall OTC over-the-counter derivatives exposure globally at the current time. The Fed has recently released a letter that is kind of basically calling out a lot of these big banks with a lot of this derivatives exposure, and the timing of this is very, very interesting, like we are going to talk about a little bit later in this video. But this is some really important info that I really want everybody to fully understand. So before we get into all of that information, if you enjoy the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So AMC closed the week at $27.44, and then in the after hours fell slightly to $27.32. Now, when we think about this week, it was kind of a perfect storm for the shorts to really try to instill more fear in retail investors. We saw GameStop's earnings, they beat on revenue, missed on EPS. Then the next day, we saw Adam Aron come out with his statement on the NFT crypto dividend, the STO, which did spark a little bit of more fear in the community, but I think we are past a lot of that now. And then we also saw some news of AMC executives selling more shares. When you think about all of those things, it really did give the shorts all of the ammo that they needed. They smelled blood in the water and they had just attacked. But when we think about what we have going over the next couple of weeks, that dirty option chain coming up for January, and the trend that we've seen on AMC and its runs around those quarterly options expirations, well, it's just going to make it even more difficult for when these time periods do come again for the shorts. So when we come over to the Ortex data right here and go over a little bit more of why this is going to be a little bit more difficult for the shorts, well, we're seeing the estimated short interest at higher levels. And with the price action that we saw on Friday, we did trigger SSR. So this estimated short interest number should get back above 19, could even get back above 19 and a half. And if it's really going to get aggressive, we could even see it back above 20. We have utilization at 77.57, and the days to cover fell slightly to just flat at 2. So when we look at days to cover, that is really going to be the metric that shows how difficult it is for the shorts to get out of their position. When we see it on this uptrend, it shows us that over time, it's getting more difficult for the shorts. Even if they wanted to get out of their position, if they did, they would just jack up the price. Now, again, when we take a look at the option chain going into January, it is still looking absolutely nasty. We are seeing 112,000 contracts in the money already and 377,000 contracts out of the money at the current time. Now, let's get into this derivative situation and the potential for these forced liquidations to really start picking up. Now, when we come over to this Fed page right here, this is going to be a statement about Archegos and what all of these institutions need to do going forward. In light of the Archegos default and in the context of firms' relationship with investment funds, the Federal Reserve is issuing this guidance to remind firms of the supervisory expectations and interagency supervisory guidance on counterparty credit risk management, and to make firms and industry participants aware of the practices that may be inconsistent with safe and sound banking practices. This letter is primarily for use by banking organizations with large derivatives portfolios and relationships with investment funds, as well as for supervisors as they assess and examine such institutions. Who could they be talking about here? Well, when we come back over to this page that we looked at last weekend, well, we know JP Morgan, Goldman Sachs, Citigroup have a wild amount of derivatives exposure, and specifically Goldman Sachs has a leverage ratio right now of 133-1. Just to put that into perspective for a lot of you guys, in 2008, Lehman Brothers, who failed, had a leverage ratio of about 40-45-1. So Goldman is way higher than what Lehman ever was in 2008. Now, the timing of this report that the Fed is releasing is very, very interesting. Now, when we take a look at when these reports came out in the past, this last report came out in September. The previous report came out in June. So we should be seeing the new report for Q3 coming out over the next couple of weeks. But I do want to go over a couple of more things that the Fed is saying in this article right here in this release, and then really dive into how deep this situation actually goes and how messed up our system is right now and the risk that these firms are holding. The Federal Reserve is concerned with practices where both at the inception of a fund relationship and on an ongoing basis during periodic credit reviews, firms accept incomplete and unverified information from the fund. Basically, trusting what the funds are saying at face value, which we're going to take a look at in a second, particularly with regard to the fund strategy, concentrations, and relationships with other market participants. That ties into what Archegos was doing, where they were essentially using the same collateral to lever up at all sorts of different banking institutions. More generally, these practices represent insufficient due diligence and may be inconsistent with safe and sound banking practices. Similarly, when initiating a relationship and on an ongoing basis, firms should attain critical information regarding size, leverage, largest or most concentrated positions, and the number of prime brokers with sufficient detail or frequency to determine the fund's ability to service its debt. If a client refuses to provide this information, which they really don't, as we see with a lot of these institutions able to get all of this leverage, firms should consider whether it is consistent with safe and sound practices for them to begin or maintain a relationship with the fund, or whether they can use strong compensating measures such as significantly more stringent contractual terms to mitigate the risk. Essentially, what they're saying here is that if these banking institutions don't see that these counterparties, the hedge funds, are really abiding by the rules that they have set out, well, they're going to need to basically liquidate them and reset these terms. The other thing that we need to think about is this word of mouth situation on how these institutions are able to potentially avoid some of these margin calls. So going back to the Archegos situation, in a bid to stave off a default, Huang arranged a conference call with banks on Thursday to ask them to agree to hold off on selling the shares that underpinned his swap trades in the hopes they would bounce back, those sources said. Some of the banks, including Credit Suisse, favored holding off, but Goldman Sachs and others were keen to start selling shares to free up cash so Archegos could pay them what was owed. So what essentially happened here is that Bill Huang basically said, I'm not paying you right now. It's not happening, and we're going to wait until this situation ends up playing out with the positions that we currently have. The other thing we need to think about is that these institutions, such as Archegos in the past, should never have been able to get these types of loans in the first place. When we come back down to this page right here, finally, the Federal Reserve is concerned that firms may agree to margin terms inappropriate to their investment fund clients, failing to provide adequate margin levels or sufficient risk sensitivity. When you look at what's being said here, it reminds me so much of the ninja loans back in 2008, where people were able to get their hands on money from the banks in order to buy a house, even though they really shouldn't have been able to qualify for those loans. That puts a lot of stress on the system, and if anything really starts to go against them, what happens? Margin calls and forced liquidations. And again, with the timing of all of this and the amount of exposure of derivatives out in the market right now, this situation could get very, very out of hand. Now, coming back over here, we need to take a look at the concentration of what exactly the exposure is in which type of asset class. So when you look over here, total swaps OTC, you can see that the most amount of concentration that these firms are holding in terms of their exposure are usually in these swaps. Now, there's been a lot of talk about whether AMC, GameStop, and a lot of these other institutions and these companies have been packaged into these swap agreements to maybe mitigate losses or for a way to kind of short all of these quote-unquote meme stocks in somewhat of a meme stock basket. Now, coming over here, we can see that the total amount of derivatives exposure globally on that OTC metric is $610 trillion. The overall derivatives exposure, I've seen over $1 quadrillion. Warren Buffett has said in the past that the derivatives market is essentially a ticking time bomb for when the next major market correction is going to happen. Now, I'm not calling for a major crash here. I'm just trying to point out to everybody that these institutions are wildly over-leveraged, and it's only a matter of time before these prime brokers, these big banks, and these hedge funds really start to have a lot of issues. Because when you think about this, leverage is very, very good when the positions are going in your favor. If you can lever up, you can amplify your returns. but it's the same thing on the way down. If you are going to lever up and the position starts to go against you, you can lose a lot of money very, very quickly. Now, going off of what the Fed was saying, that there needs to be more strict rules on these margin requirements and how these banks are essentially going to be issuing out some of these loans. Well, we already know that Phase 5 UMR from the DTCC is in effect. This came in effect on September 1st, and the quote here, there will be an upsurge in the volume of margin calls and an increase in the need for third-party custodians to keep safe collateral. As a result, UMR will likely require many buy-side firms to make significant changes to their existing collateral management processes. So what we have here is a situation where over time, maybe it's going to take a couple of months, maybe it's going to take a year, but what we know is that there's going to be somewhat of a wave of deleveraging. And what that is going to do is create a lot of selling volume eventually, or short covering on short positions that these firms are down absolutely horrendously on. The other thing that we really need to keep in mind is that Archegos, back in March, when they really had their absolute disaster, they're not the only ones doing this. They're not the one that kind of found this big loophole in the market to really exploit a lot of these margin tactics. They're just the ones that got caught for it. Now, it's very similar to what happened back in 2008 with Lehman Brothers and all of these other large banking institutions. They were all messing around with these really risky mortgages and risky mortgage-backed securities, but Lehman was just the one that really got caught with that bag at the end of the day. You can't have $182 trillion of risk exposure and not expect things to start to go awry. Now, could it be a Citadel, a Virtue, or any one of these other large institutions that we suspect of being over leveraged on a short position on AMC and GameStop, and any one of these other stocks that we like to take a look at? It absolutely could be, but it's going to be very, very hard for us to actually dive deep and figure out exactly who it is, just due to the way our reporting standards are set up at the current time. But that is going to wrap up this update on AMC. If you guys enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. And again, I apologize for my voice in this video. It is getting better. I was sick a lot this week. I am starting to feel a lot better today, though. So hopefully by Monday and tomorrow, we'll be back to completely normal. So I hope you guys are having a great weekend, and I'll see you guys in the next video.